Good morning, everyone. Today is Wednesday, September 30th, 2020, and it's our weekly professional services strategy call. And what I wanted to do today was dedicate the entire session, which will be a little bit of an abbreviated session, to talking about the specific changes to the equity select lists as well as the Zacks equity model portfolios. The changes are reflected in Advisor Tools as well as the Zacks Research System composites effective today and yesterday is when we actually put them in. Many of you have received alerts. We've sent out emails, and within the email, you've seen this particular set of changes, and we're going to just walk through some of the higher points of those changes now. Up here under the Zacks Research tab in the Zacks Advisor Tools platform, beneath the equity select list, remember that it's the standard industrial portfolio, the Zacks growth portfolio, and the cyclical portfolio that feed into the equity models. So the earnings certain portfolio, the Admiral, the dividend aristocrats, the tilts, and the focus list is completely separate. So the idea is that the equity select list, we allow our clients access to these at no additional charge. And then obviously the equity model portfolios themselves, those are a premium add-on, or what we call a premium service. So let's go ahead and get started with some of these changes. First, just a couple comments on changes to the equity select list, and keep in mind that the standard industrial portfolio, this is the larger 400 stock universe from which the cyclical and growth portfolios, each 200 members, are derived from. And this is the pulse of the U.S. economy. So it's a much cleaner pulse of what's going on in the U.S. economy, minus the tilt sectors, and also minus stocks that don't have any analytical relevance to what's going on in the U.S. economy. And I'm going to point out a few of those names that I actually removed this quarter in just a moment. But the most important thing is that it doesn't contain any of those tilt sectors that would otherwise skew our valuation metrics. So we're able to come in here as analysts and portfolio managers and do real meaningful valuation work. Keep in mind that we then split the standard industrial portfolio into two groups based on earning stability. We've got the growth portfolio and we've got the cyclical portfolio. And obviously, if you wanted to know what was going on with any of the value-oriented names, here's 200 names in the cyclical portfolio, and you can see how the recovery in earnings that are being forecasted have been priced in terms of valuation. And I just want to remind everyone that's an Advisor Tools user that beneath the research menu, that list of 200 names can really come in handy if you want good quality, value-oriented names. I know that Goldman Sachs, Morgan Stanley, everybody has been coming out recently saying, increase your exposure to value names, the cyclically, economically sensitive names in our economy. And everyone gets free access to this list of cyclical names. So please use it. Okay. So bring everyone's attention very quickly to the removals from the equity select list. So Ascena Retail Group, it's very sad what's happened to the retail space. And this name, along with Briggs & Stratton, this name was removed basically due to bankruptcy, right? So this was Ann Taylor, The Loft, Lane Bryant. They're basically a specialty retail holding company. They own a few more names as well. Legg Mason ended up merging with Franklin Templeton. The ones that I want to review is the Fossil Group, Bed Bath & Beyond, and Pitney Bowes. And just to kind of show you very briefly what these names look like from a price and earnings perspective. And you can see that, we've got a significant broken growth story here with Pitney Bowes. And it just, as far as serving any analytical relevance for our portfolios in terms of the standard industrial portfolio, growth or cyclical, there's just really no place for this name any longer. So it has to be removed. Same thing with Bed Bath & Beyond. This was obviously a darling stock in the early 2000s. and it's just broken growth now. So it's been removed as well as fossil. Okay, similar stories there. So go back to our Word document here. The names then have obviously flowed through to removals from the cyclical portfolio, the growth portfolio. But what I want to do is I want to focus our attention on the changes specifically to the core 75 stock earnings certain portfolio. And keep in mind that if I take you back into Advisor Tools very quickly, it is from the 75 stock earnings certain portfolio that, remember, we strip out the 35 names that are subject to some sort of reopening phenomenon. It's actually 45 names. And we end up with the earnings certain Admiral portfolio. So we go from 75 names down to 30 names in the Admiral. And the Admiral portfolio is going to be the portfolio that is completely agnostic to even a U.S. government shutdown, right? So we shut down the economy. These 30 names are still going to be your names that thrive and grow at the same previous pre-COVID growth rates, and they're just an unstoppable group of companies. So I've had many questions about, how the earnings certain family of portfolios behaves when value outperforms growth, when growth outperforms value. And I wanted to spend just a moment commenting on that. For clients that are interested in, a barbell type approach where they have a group of names that are going to, serve well in a value recovery, keep in mind we have 45 now value type oriented names that are going to partake in a rotation when one finally does occur, and we're actually seeing a little bit of a rotation this morning. Names like Starbucks and Disney that are obviously still of earnings certain caliber that got bruised very badly during the U.S. Economic shutdown are still in the earnings certain portfolio, and there's 45 like names like that where you'll be able to participate in that barbell. The more defensive portfolio has been the Admiral portfolio, and there are no names that are really going to participate in that recovery. There doesn't need to be any of those names in the Admiral portfolio. Why? Because they never got hit. So this is obviously a more defensive portfolio, has a much lower beta even than the earnings certain portfolio. But keep in mind, over the long run, the earnings certain portfolio and Admiral portfolio will perform more or less exactly the same. And I will show the forecast growth rates on earnings here in just one moment. As a matter of fact, I can take you into the research system right now and show you what I'm talking about. So if we look at the core 75 stock earnings certain portfolio, and I go over to the valuation model. Now keep in mind that this is the portfolio now with the changes that we've made, and you can see this 45 stocks impact on forecast growth. So still a very stable trend, but still not the upward trend that we like to see through recessions. But it's understandable when you shut down the entire U.S. economy. Where I'm going with this is, if we turn on the valuation model just to get access to this least squares trend rate, you can see that since 1995, if we apply a least squares trend rate to the growth in underlying corporate earnings for the portfolio in aggregate, you can see that we are at 11.88% growth. So over the long term, this portfolio is going to grow at basically 11.88%. And if I then take the Admiral portfolio, and this is again the reason why the portfolio is the performance is very similar, and I apply a least squares to the Admiral, you'll see that it's 11.84. So there's only a 4 basis point difference in least squares earnings growth over that time period from 1995 to current. And so you would expect that then the price performance would be roughly equal. And if you look at a performance chart, you'll see that that's the case. And I would have to change this to, keep in mind these strategy sessions are live, so I'm actually working the system as we are talking here. So Here is the Admiral portfolio performance since 95 compared to the core 75, and you can see that they're roughly the same. They mirror one another long term, okay? And what I was referring to with regards to the performance year to date, if you look at that, you'll see that the Admiral portfolio is a little bit more defensive natured. So that's where you're going to see the recovery in those value names for the earnings certain finally pick up. And eventually this performance in the core 75 will come back to the Admiral portfolio. So that's how you play those two portfolios. That's the difference between the two portfolios. And the last thing I want to show in the Admiral is I want to come back to the price and earnings for everyone. And I want to go back to that 25-year chart. And I just want everyone to see that we have a little bit of a flattening of the growth for even the Admiral, but you'll see that it's actually less than the core 75. So you can see it's actually a little bit of a dip here for the earnings certain core 75. If I go back to Admiral, you can see it actually flattening out a bit. So a much nicer trend there for the Admiral portfolio. Keep in mind, while we're on the same topic of discussion, that we have the top 25 dividend names out of the earnings certain core 75 portfolio as the dividend aristocrats. And you can see that we've got the yield at about 2.63, so a much higher yield than the core 75 or even the Admiral. And you can see that we've still got a solid trend in growth, and you can still see that earnings certainty that we would expect from our family of portfolios. But where you end up getting a little bit of a performance drag, as you would expect out of your dividend aristocrats, is the fact that not as much of the net income is being reinvested for growth. And so you can see that the growth rate, if we look at the least squares trend on the dividend aristocrat portfolio, is a little bit less than the more growthier oriented core 75 earnings certain portfolio, along with the more growth oriented ECP Admiral. So still about a 9% growth rate, which is spectacular. If you were to compare that to the proxy for the S&P 500, the SP5M, you're looking at something much lower at about 7.13%. And if you were to look at it indexed, so the actual S&P 500, I think it would be much lower than that. So let's see what that is. It should be. Yeah, so it's only 5.58%. And keep in mind that when you look at the S&P 500, again, this is what we're trying to avoid, are these cyclical soft patches that you drag your client portfolios through, and performance more or less gets taken to the woodshed. So again, not to beat home the advantages of the earnings certain portfolio much longer, but it's no wonder that portfolio in core even continues to outperform the S&P 500. It's just such a much more reliable. Even when you look at risk-adjusted returns, they're basically 2 times the S&P 500. So that's not even considering the profitability ratios and everything that we've been through. So just a ton of advantages there. So let's take a look at what we did with some of the changes to the earnings certain portfolio. And I love to talk about the names, which we'll do right now. So we removed John Wiley, we removed Raytheon, we removed Walgreens, we removed this Dentsply, which is basically dental supplies, and we removed Campbell Soup. And keep in mind that those then flow through. The Admiral had Campbell Soup, it's no longer in there. And the Dividend Aristocrat portfolio had Campbell Soup as well as John Wiley. They're no longer in there as well. So with regards to the ECP Admiral, we put Rollins in its place. Rollins is the holding company for many pest control corporations that work on long-term contracts. Spectacular company. They own Orkin, among many others. And with regard to ECP Dividend Aristocrats, we literally just swapped out Hormel Foods for Campbell Soup. It was kind of a no-brainer. You'll see in a minute. And then Quest Diagnostics replaced John Wiley. Okay. So let's just look at this for a moment. And what we're going to do, I showed this 2 weeks ago. I'm going to show it again very, very briefly. the price and earnings impact of the removal names. So these are the 5 companies that we removed. And you can see, obviously, earnings certain quality all the way through up until the end of basically 2018, 2019. And then we just had this collapse collectively. And that's one of the reasons why. And I'm going to change this over to price and earnings. Get rid of all that noise. And so if we look at some of these names that we removed, you'll see exactly, what happened. It just doesn't look like this growth and stability for Campbell Soup is going to pan out. It was time to remove them. And it's kind of the same scenario with John Wiley Publishing Company. Everything's going digital. We've got COVID now, a totally different story. Raytheon went through a recent merger, obviously no longer of earnings certain caliber. There's a lot of other defense names we could have put in here. I looked at them and decided to go a different direction. Walgreens, obviously, a lot of issues with margins, a lot of issues with the prescription drugs and everything else. They're gone. Dentsply, this again was the dental supply company. Another one that we removed back in March, just to kind of show you how these two companies mirror one another. This dental supply group of companies was just earning certain caliber for years. And Patterson Companies was another one. And it's very, very similar what happened to them as well. They were just earning certain caliber for years, and then we just, hit this slump. And it just doesn't look like it's going to come back anytime soon. I know that the FY2 and 3 growth rates are back to 10, 11%, but there's just been too much damage done for them to stay in the earning certain portfolio. So I removed Patterson actually in March of this past year, similar to X-ray stocks, the Dentsply. So let's go ahead and look at the additions. If I can spell, and what those look like from a price and earnings perspective. And obviously a much better contribution to the ECP family. And again, just to kind of bump through some of these names, Linde was the old Praxair, obviously rock solid when you're talking about industrial gases, nitrogen, welding type gases, those sort of things. If you have children or are addicted to the energy drinks yourself, you'll know the name Monster. They're also big into the adrenaline sports sponsorships, so you've seen their name everywhere. Just massive, consistent growth from Monster, and more than happy to add them to the family. Mettler Toledo is probably not a well-recognized name, but they, as you can see from the earnings line here, absolutely spectacular growth. They pay no dividend, but this trend rate in growth for their laboratory type equipment is just phenomenal. And then obviously ResMed, who's doing a lot in the space of wearable medical technology, everything from heart monitors to glucose monitoring, and I think they're even doing stuff now with sleep apnea and that sort of thing. So there's just a lot of good things going on over at ResMed. So those are more or less the changes. And again, what I wanted to do was just take a minute to mention and give some of my thoughts on what's going on with the election. Obviously, we had a stunning debate last night, which, if anything, it probably caused more confusion than anything. And I also want to talk again about, how these earning certain family of portfolios are positioned for not only the election, but this growth versus value cycle, just to make sure everybody's on the same page. So if you look at the earning certain portfolio over time, the only real event that you can see here is the Great Recession, and you can see a little bit of COVID. And if we look at the Admiral portfolio, it's even less a factor for the Great Recession and less a factor for COVID. And as far as 9/11 is concerned and the dot-com bust, pretty much non-factors. And so the idea here is that if you look at this chart, you really can't point to any presidential election and say, oh, the Admiral took a hit, or the earnings certain portfolio, Core 75 took a hit. And, that's the idea. That's why we build and maintain these equity model portfolios, is so that our advisors and their clients can sleep at night. So my take on this election cycle is that it's being hyped up to be this massive market volatility event. And I think that we've got a lot of people, especially our advisors' clients, trying to be prepared for it. I know a lot of advisors that are actually moving their clients to large portions of cash, which I'm not sure I necessarily agree with. My take on this is that it's not going to be as large of an event as everyone expects. And there's a couple reasons for that. One is that it's being hyped up so much already, and we've already had such a correction ahead of the election. The other thing is that we have pretty much a known incumbent. There's no real mystery as to how Donald Trump is going to continue to play his hand if he wins this reelection. And I would say that with regards to Joe Biden, he is also a known factor for the most part, right? We might have an increase in taxes. There might be some one-time hits. We may have some advantages to Amazon versus Apple if Biden versus Trump were to take office. And we've got, obviously, Trump with a personal vendetta against Jeff Bezos at Amazon might continue to pursue them. I mean, who knows, right? Apple, being the world's largest taxpayer to the United States, may end up, from a corporate perspective, taking a hit if Biden raises corporate tax. I don't know. But the idea that this is going to be a major market-making event, this election, even if we go a couple weeks not knowing who the president is going to be and the Supreme Court has to step in and rule, I just can't see, looking back at this particular chart, how this is going to be a big event. It's not going to change anybody's buying habits for sure. And these companies in the earnings certain portfolio, at least, they're going to continue to chug along as they always have. So again, when you look at the history of the earnings certain family of portfolios, price and earnings back to 1995, you really can't point to growth cycles versus value cycles and say, oh, growth outperformed value. How did the earnings certain portfolio do? Why? Because the earnings certain portfolio just continues to trend up and up and up as this long-term trend rate in earnings continues to just trend up and up and up. PE multiples will expand and contract. That's going to take place in the face of changes in the forecast for macroeconomic headline risk. We monitor that as well. Here's your 11.88% long-term trend rate. And if we look at the forecast for macroeconomic headwinds by looking at equity risk premium, which I can get to by going into the Zacks Quick Analysis Pitch Book and just coming down here and grabbing it. I see equity risk premium that just continues to be on the decline, which warrants further PE multiple expansion. So at least in the short term, I just don't see how equities don't continue to rise. And you can see this decline in equity risk premium and the total equity discount rate. Here's your equity risk premium decline. And you want to look at this over multiple years. And you can just see that outside of the COVID spike, which led to the collapse in forward multiples, you can see that the equity risk premium continues to decline and that we should end up actually seeing a reversal in this forward multiple, right? And this is on the earnings certain portfolio. So again, I don't see how this election cycle is going to be a material event longer term. So when you're talking to clients, if they have questions or concerns about their client portfolios, or they want to meet with me and have some discussions around their portfolios or allocations, I'm more than happy to sit down and spend some time with them. And we can even create a composite or two and take a look at some of their exposures. So that's all I had for today. and we'll go ahead and pick up this discussion next week. Thank you, everyone.